Welcome back to the Deep Dive. Today we are jumping into the very volatile world of discretionary retail. We're focusing on Vera Bradley Inc., that's VRA, and their Q3 fiscal year 2026 earnings print.
And this is such an essential one to unpack because it's a story of really intense conflict in the market. The headline numbers looked, frankly, just disastrous.
Right. The stock plunged in the pre-market.
It did, severely. But then within 24 hours, it had completely reversed course. And that signals this massive split between the backward-looking numbers and the forward-looking strategy. So our mission today is to figure out why the market just chose to ignore such a historically bad quarter.
Okay, let's get into it. This is a classic American brand, trying to find its footing. And Q3, on the surface, looked like the turnaround had completely stalled. So give us the raw numbers. What did revenue look like?
Well, revenue was this tiny, tiny silver lining. The company reported $62.3 million.
So that beat the consensus, right?
It did, technically. It was just ahead of Wall Street's $61.7 million. But, and this is a big but, that beat is really deceptive.
How so?
Because it was still an 11.7% decline year over year. I mean, they did $70.5 million a year before. So yes, they beat a low expectation, but the business itself is still shrinking.
A shrinking beat. Yeah, never a great sign. But that wasn't the real shocker, was it? The number that made the stock just crater was the profitability?
Precisely. The earnings per share, the non-GAAP EPS, was a loss of 30 cents per share.
30 cents. And the expectation was what?
The consensus from Zacks was for a loss of only 11 cents. So that's a huge gap. We're talking about an earnings surprise of negative 172%.
Wow. That's the definition of a massive unforeseen loss. So the big question is, if they lost 172% more money than expected, why on earth did the stock recover so fast? And I think the answer is in the details, in the strategic cleanup.
It is. You have to look at the charges that basically made the Q3 profitability useless as a metric for the underlying health of the business. Management took these huge non-recurring hits. They basically decided to take all their medicine in one go.
Okay, so what was in that medicine? What were the charges?
Two major buckets. They totaled about $10 million in, let's call it, financial self-destruction. First was a huge $5.9 million inventory write-down.
And this wasn't because the product was bad or unsellable?
No, not at all. It was strategic. They're pivoting hard back to their roots, cotton, heritage prints, and they had to clear the decks of all the old stuff that didn't fit that new vision.
So they chose to burn cash to get focused.
Yeah.
What was the second big charge?
The second was a $4 million write-off of television media credits.
TV credits.
Yeah. These were bought during their last turnaround attempt, something called Project Restoration, which obviously didn't work. The new strategy, Project Sunshine, is all about digital and performance marketing. So those TD credits were suddenly worthless to them, a sunk cost.
That's fascinating. So you add the $5.9 million inventory hit to the $4.0 million media write-off. That's almost $10 million in charges. The management team was essentially saying, we just paid 35 cents a share to clean up our past mistakes. And the market liked that.
Exactly. It's a narrative of strategic sacrifice. The market decided that $10 million of pain right now is worth a future of clean, profitable sales.
So the loss was voluntary. Let's look at the underlying business health then. Gross margin. The reported number looked awful, 42.1%, down from 54.5% last year. That's a huge 1,240 basis point drop.
It is, but that drop is entirely the inventory write-down, and this is probably the single most important number for anyone looking at VRA. Management pointed out that if you exclude that $5.9 million cleanup, the gross margin was actually 51.2%.
And that 51.2% figure, that's the proof point.
It is. It represents the third straight quarter of underlying gross margin improvement. Once you trip out the noise, the core business is actually getting healthier. It suggests their pricing and product mix are starting to work.
Okay, so let's zoom out a bit. What about corporate health? Liquidity, efficiency. I mean, liquidity seems pretty tight, which is always a risk.
It's definitely something to watch. The company only has $10.7 million in cash. And for a retailer this size, that's a very thin cushion. Their margin for error is small. On top of that, they had $10 million drawn on their $75 million ABL facility.
Oh, wait, can you explain what an ABL facility is for our listeners? Why does that matter here?
Sure. An ABL is an asset-based lending facility. It's basically a credit line that's secured by the company's assets, like their inventory. The fact they've drawn $10 million means they're using their core assets to fund day-to-day operations, which just signals that cash is tight. They need things to improve and fast.
But there is one area where they're showing some really good discipline, and that's inventory.
They are, and this is crucial for cash flow. Inventory was slashed by 24.3% year over year. Management's big goal is to improve inventory turns. Right now, their turns are below 2.
And a turn rate of less than 2, what does that actually mean?
It means they only sell through their entire stock of inventory about once, maybe twice a year. That's really slow for fashion. The goal is to get that up into the 2 to 3 range in the next year or so. The faster they move product, the less cash is tied up on shelves, and the quicker they can pay down that ABL.
All right, so we've covered the financial cleanup. The margin is getting better, inventory is tightening, but that's just potential. What's the actual plan to get customers in the door? This is where Project Sunshine comes in.
Right, this is what the market really focused on. Project Sunshine has 5 pillars, and it's all about reclaiming the brand's identity. You've got sharpening brand focus, resetting go-to-market, rewiring digital, outlet 2.0, and an organizational redesign.
Let's start with the product. Pillar 1. They're going back to their roots, cotton and heritage styles.
Absolutely. The executive chairman basically admitted they'd lost track of what made Vera Bradley special. So they're bringing back the icons, the original hunter bag, the Vera tote. And importantly, cotton is now over 50% of the product mix, up from under 40. They're done chasing trends.
And pillar 2, the marketing shift. That's what really got the Gen Z headlines going. Writing off $4 million in TV credits was a huge statement.
It was a complete repudiation of the old way. The new focus is social-first marketing, and they have the data to back it up. The original 100 bag campaign, for example, it drove new customer acquisition, and it achieved twice the penetration of Gen Z customers compared to their other products.
Doubling Gen Z penetration on one style. That is the holy grail for a legacy brand. But how do we know it wasn't just a one-off viral moment?
Well, that is the execution risk. But management is treating it as a scalable proof of concept. And that ties right into pillar 3, rewiring the digital ecosystem. It's more than just TikTok ads. They're making sure the whole e-commerce journey is optimized for that new, younger customer.
Okay, so that covers digital. What about their physical stores? The mall is a tough place to be. How is Outlet 2.0 different?
It's a shift from just being a dumping ground for old inventory to what they call a smart value curated experience. Remember we talked about SAU rationalization?
Right, just cutting down on the number of different products they offer.
Exactly. They cut SKUs by 35% in their pilot outlet stores. And the early results from the holiday pilots showed positive conversion. So they're getting similar or even better sales from fewer items. That's a huge boost for profitability.
And the last pillar, organizational redesign. That sounds like the internal painful part.
It is. It means the company's structure has to change to support this new vision. You don't just write off $4 million in media credits without some big shifts internally. It's about getting everyone aligned with Project Sunshine, not the old failed Project Restoration.
So let's pull back out. The stock drops, then recovers. The charges masked improvement. But one question. If the strategy is working and momentum is building, the direct segment decline improved from 16% in Q2 to just 5% in Q3. Why is the core business still shrinking at all?
That's a great question, and it speaks to the risk. Management was very clear this is a sustainable build rather than an overnight turnaround. The shrinkage is happening because, 1, they're deliberately cutting non-core products, and 2, the full benefit from that new Gen Z customer just takes time to show up in the top line.
So the sequential improvement is what matters. It validates the direction, even if they haven't reached the destination of actual growth yet.
Precisely. 5 straight months of positive comps in their core channels proved the trajectory was right, and that overrode the bad EPS number.
And collaborations are the accelerator for that.
Yes, the Anthropologie collaboration was a huge success, and management promised more collabs for spring, summer, and fall/winter 2026. This is their way of using other brands to introduce the new Vera Bradley to fresh audiences fast.
Okay, so we have a high-risk turnaround, trading near historic lows, tight on cash, but with a clear positive trend. This brings us to the segment where we look at the aggressive potential. This is not financial advice. Time for the outrageous but plausible trade idea. What do you have for us?
My pleasure. And first, the clear reminder. VRA missed earnings badly. Liquidity is very tight with only about $10 million in cash, and the stock is at $1.95. This is highly speculative. Your capital is at risk.
Understood. Lay out the high-risk pitch.
The pitch is a high-risk long position in VRA, and the thesis is what we're calling the Gen Z inflection point. We are looking for the stock to potentially double based on proof of concept alone.
So this is basically the original 100-bag thesis as an investment strategy.
Exactly. The core idea is that the success of that campaign, doubling Gen Z penetration, Proves they found the right product, their authentic DNA, and the right channel social media to connect with a whole new demographic. Project Sunshine is authentic, and that's why it might actually work.
So what's the immediate catalyst you're betting on to make that happen?
We're betting that the 2026 collaborations and the new prints for those iconic styles will stabilize their core sales faster than anyone expects, and crucially, that it will accelerate their inventory turns from under 2 to over 2. If they can just hold that 51.2% clean margin for another couple of quarters, the stock is so depressed that any proof the plan is working could trigger a major re-rating from the market. We're buying the story before the numbers fully prove it out.
A high-conviction narrative trade, banking on Gen Z to solve a cash flow problem. Okay, let's wrap this. The core tension here was a big earnings miss, driven by about $10 million in one-time charges that actually masked some really clear positive traction under Project Sunshine.
The two key things for you to watch are simple. First, can they sustain that 51.2% clean gross margin that has to hold? And second, does that Gen Z traction actually scale through the new collaborations? We need to see that translate into better inventory turns and comps stabilizing.
So for you, the learner, trying to process this messy quarter, what's the big takeaway? We saw management very explicitly throw out the old strategy, even writing off $4 million in TV credits from that failed project restoration. They've pivoted hard back to their original DNA.
And this raises the one critical risk investors have to weigh against all this new product success.
They cleaned up $10 million worth of mistakes this quarter. But how much other stuff, how much residual cost from those failed attempts is still hiding on the balance sheet, waiting to pop up in the future? Was this the final bill for the past or just an installment? That's the question we'll be watching.
A fitting challenge for any turnaround story.
Thank you for joining us on this deep dive. We hope you feel well informed and ready for the market. We'll catch you next time.